How do startup tax implications attract venture capital? Imagine a world where investing in early-stage companies feels safer and more rewarding. That's where understanding startup tax implications can make a big difference for venture capitalists. When startups are structured smartly, they can offer tax benefits that make investing more appealing. For example, many startups operate at a loss in their first few years because they spend heavily on developing products and gaining customers. If these losses are structured correctly, investors can use them to lower their overall tax bills. This is easier with business forms like limited liability companies or pass-through entities, where losses pass directly to investors. But many startups choose to become C corporations because investors prefer the familiarity and the way stock options work. Capital gains tax treatment is another key factor. When venture capitalists sell their shares after a successful exit, they usually pay lower long-term capital gains taxes. These are taxes on profits from investments held for more than 1 year, and they are lower than taxes on regular income. This makes long-term investments in startups more attractive. There is also a special tax benefit called the qualified small business stock exclusion. If investors hold startup stock for at least 5 years and meet other rules, they can exclude a large part of their gains from federal income tax. This can significantly boost after-tax returns and encourage more investment. Recent changes in tax laws have made startup investing even more appealing. For instance, increased bonus depreciation allows startups to write off large capital expenses immediately, helping improve cash flow. The Section 199, a deduction for pass-through entities, also makes these structures more tax efficient. This means startups can keep more of their earnings and attract more investors. For Asian American entrepreneurs and investors, knowing these tax rules is especially helpful. Many face unique challenges in raising capital and navigating complex tax laws. By understanding how choosing the right business structure and taking advantage of tax incentives like the qualified small business stock exclusion can make their companies more attractive, they can draw in more venture capital. Investors within these communities can also benefit from these rules to maximize their returns. Startups looking to attract venture capital should think carefully about their organizational form. Choosing between a limited liability company and a C corporation depends on their goals and investor preferences. Planning to hold stock for at least 5 years can unlock big tax savings through the qualified small business stock exclusion. Using available deductions and depreciation rules can also improve cash flow early on. Working with a tax professional familiar with startup and venture capital rules can help optimize these strategies. When startups align their tax plans with what venture capitalists look for, they become much more appealing for investment, helping them grow and succeed faster.